A market update in the Far East, where most Asian markets rose as investors were cheered by Donald Trump's belief that the US and China could reach a great trade deal, in the words of Donald Trump, which did help ease concerns over a report that he is preparing to lump tariffs on all Chinese goods. Investors started the day on a nervous note, where investors were already fretting over a number of issues, including geopolitical tensions, rising US interest rates, slowing growth, Brexit, and Italy's budget standoff with the EU. Tokyo's Nikkei gained 1.5% to close trade at 21,457 points there. Hong Kong's Hang Seng stuttered as it dipped almost 1% to 24,585 at close. Shanghai's Composite fell 1% as well, 2,568. U.S. stocks fell last night in a volatile session, with the S&P 500 ending just shy of confirming its second correction of 2018, hurt by fresh worries of an escalation of U.S.-China trade tensions and a sharp drop in big tech and internet names. Now, following a morning rally, major U.S. indices pulled back steeply after a Bloomberg report that the U.S. is preparing to announce tariffs on all remaining Chinese imports by early December if talks next month between Presidents Donald Trump and Xi Jinping falter. Facebook, Amazon, Netflix, and Alphabet have lost more than $200 billion in market value. That's just in the past two sessions. The Dow Jones Industrial down 1%, 24,447. S&P 500 0.2% down, 2,641. The Nasdaq Composite also dropping 1.6% to 7,050. It's been a negative tinge to the market all across the board, and one would hope that there'd be a bottom out. But where that bottom is something that all market traders will certainly be looking out for. The Rand staging somewhat of a comeback, but still hovering at 14 Rand 60 odd against the US dollar. Not helping locally as we get back into red territory. Let's unpack that and how the European markets are faring. Well, when I generally don't understand themes, I usually call in an analyst. But here's something that has boggled me for quite some time, and it seems like it's happened over the last couple of weeks as well. There's something called a tech stock tumble. Globally, it seems to have affected a number of stocks, and these aren't even all of them. Things like Google as well have gone down. Just from their highest point in the last year, it seems that the likes of Tencent have dropped 47%, Facebook down 35%, Alibaba 34%, 33% for Netflix and Amazon. And I want to take a look just specifically at Tencent, because this is about to take shape into what happens with Naspers, because that is a prominent feature on South Africa's stock exchange. And if we take a look at the local tech stocks that have also faltered this year, you'll see a similar picture. So all of them as well going down in a similar fashion. Blue Label Telecoms falling down 66% and 61% for Data Tech. EOH going down 54%. AO Technologies at 44%. But look at that, Naspers also going down around 34%. A lot of that based purely on just what has happened with Tencent, also down from its 52-week high, 34%. And this is all before the trade, before trade started again early this morning. So it's an interesting picture. And as you can tell there, those tech stocks suffering in that process. And let me ask somebody who perhaps would know a little bit more about this, Martin Harris from IG South Africa, unpacking this for us. Martin, it's been an interesting picture there. As you can see, it's red behind you on month to date, red behind you on year to date as well. So it's a negative picture, and those tech stocks certainly not helping.
No, absolutely. Thank you, Arabella. We've seen the US tech stock tumble as well as at Asian markets, and it's sort of triggered by them missing earnings expectations. So what could be apparent is that all of the tech stocks were overvalued, and that there's been a correction in the market, and they've brought each other down. So as investors have seen one miss earnings, what they'll do is they'll just start selling off on the rest with an expectation that in general tech stocks were overvalued. Tencent, slightly different. Tencent has been battered by Chinese regulators. Tencent has a very large gaming division, and the Chinese regulators have restricted access to releasing new titles because they feel that they don't meet certain standards around if they're suitable for teenagers or children to play and so on. So they've restricted those titles being released. So there have been no new games released by Tencent now for a few months.
That certainly helped hurt to the stock even today, down 2.8%. It's scary though, because the JSE seems to be headed well towards that 50,000 point mark and even keen to head a little bit lower. Do we have an exact reasoning for this meltdown, or perhaps not so much of a meltdown, but really a big fall? It's nearly 9% for the year.
Look, the JSE unfortunately also follows around what happens in the rest of the world and not just what's happening in our local economy. Yeah. We've had an emerging market sell-off now for several months, and I think we have been in a decline for several months. So we have almost been in a light-style financial crisis on our stock market. And only the United States have really stayed in the green for the year. They now have also started a sell-off. We see that as their monetary policy normalization is starting to filter through to investors. Investors in the United States are starting to take money off the table, saying this run has been good, let's take some profits on the table. I don't believe that the United States is about to crash, but certainly it was pumped up by the tax reform that Donald Trump's administration brought in, and there's a lot of share buybacks whereby companies were given tax cuts, and those tax cuts they used to, some of them pay higher salaries, and the rest of them use the rest of that money to buy back their shares and elevate the price in the market.
Yeah. Certainly an interesting one. The MTN had their quarterly update yesterday, but they're also said to perhaps delay their listing in Nigeria, some would say for obvious reasons.
Absolutely. So MTN are busy facing a new battle with Nigerian authorities. Now, there's a lot of accusations we can throw at the Nigerian authorities, but the facts are currently that their central bank is demanding $8 billion from MTN in what they said were illegal dividends that they repatriated out of Nigeria. So they want the money back and delivered to the central bank. And they've also fined the banks that were associated with MTN withdrawing that money from Nigeria. And then the Nigerian tax authorities are looking for $2 billion US in payments. So this is the second time that we've seen Nigeria and MTN in a bit of a sticky situation, and they came to an agreement previously, and the fine that they were required to pay was reduced substantially. We might be seeing a repeat of that, but definitely the Nigerians mean it when they want a penalty to be paid. So MTN aren't going to be able to walk away from this without paying something. There will be an agreement that needs to be reached.
If they were to sort this matter out, it clearly would offer some potential upside perhaps in the business, considering how far down it has gone because of this. But another story is Moody's S&P giving out a negative sort of sentiment around South Africa. S&P even saying that we risk another downgrade here.
Absolutely. So just for out of interest, Moody's is the only sovereign rating agency that still has us above junk status. And so if they were to negatively downgrade us, and they've said that our medium-term budget was credit negative, so they could put us on negative watch and look to downgrade us. S&P already have us on on junk status and are saying that we could deteriorate further because we're delaying our fiscal consolidation. We've got issues around policy and land expropriation that haven't been settled yet. They'd like to know what it is that we're going to do. And so because of that, the rand is being hit. So we are weakening at a faster pace, or accelerating, compared to other emerging markets, even after we saw President Ramaphosa raising money with his sort of investment summit abroad.
Martin, let me ask you very quickly, the South African Reserve Bank quite keen to raise interest rates. That's potentially because of the environment we're currently in, right? It's not really going to help growth, and it's certainly going to hurt consumers.
Absolutely. It's quite a tough situation the Reserve Bank are in. They're not mandated to drive growth in South Africa. So as much as a consumer, you would want to have really low interest rates that you can continue to consume on debt. Reserve Bank are currently, their mandate is to protect the currency against inflation. And what we're seeing is that the currency is getting absolutely battered. We're facing a battle on many fronts where we have emerging market sell-off. We've got the issues with oil prices, and we also have just in general a weak rand. And so a weak rand really is where most of our inflation drive comes from. So what the Reserve Bank governor has stated is that over the next 2 years, what they've modeled, we're currently at 6.5%. We could go up to 7.7% over 2 years. So that would be quite bad for growth. But ideally, what we'd like to see from an investment perspective, apparently the private sector is sitting on 1 trillion rands worth of capital. And if we could get some political policy changes that could offer some return on investment, could unleash some of that capital and deploy it into the economy and get the economy growing that way rather than through reducing interest rates.
Well, the president says the investment strike is over, so perhaps we will begin to see some of that. Martin, I do call on you for the smart answers, so thank you for all of those today. Martin Harris is from IG South Africa there. That is where the buck stops when it comes to the market. Back to you, Nzinga.